Hey, what's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today, the three of us are going to talk about mortgage rates easing a little bit, but also we're going to talk about foreclosures, which now seem to be on some sort of like crazy uptick. And
it's happening.
We haven't talked about foreclosures in a little bit, so I want to make sure we spend time today talking about it. So I said the dreaded F word on camera right now.
Yeah, it's happening.
Let's talk about mortgage rates first, though.
Yeah.
We're deep into October by this point, and even though mortgage rates took a nice little dip before the Fed meeting in September, they immediately went up right after that. But then they kind of been like slowly getting a little better, but not enough where it's like, hey, tell everybody and all your friends and neighbors.
Yeah, but you know what? At the same time, it's a lot better than last year's experience. Yeah. I mean, last year's experience, as soon as Uncle Powell just freaking mentioned that, the Fed funds rates was cut, it was like, why did rates go up? Like, why did everything just continue to go up? So we're seeing the same kind of effect this time around, but it's not as steep as it was. Because if you recall, towards the end of the year, we're already hitting the sevens again.
Yeah.
We're like, what the heck is that? Why is that even happening? So for now, let's see what happened. And we already know that, we feel very confident that on the next Fed funds meeting, they should do another quarter cut. So
yeah, and I know that I've been seeing a little bit of conversation about the whole government shutdown. Like, well, does this help the Fed cut argument, or does it hurt the Fed cut argument? I mean, candidly speaking, it's probably going to aid the cut, because if the government shutdown lasts continually longer, then it's kind of more of a reason why, hey, we need to do something to kind of get back on track where we're supposed to be had we not been shut down. Yeah. So I can see that being another kind of log on the fire of that argument. Again, the Fed has been, I think, a little bit inconsistent in why they do or don't make cuts up to this point anyways. So I guess I shouldn't be surprised if they do or don't. I'm now just leaning more so that they're going to.
Yeah, I agree with you 100% with that. This should help we should expect that cut.
Rates haven't nose tanked.
Hey, week 2 in the nose tank.
No nose tank.
We created a brand new word on the show last week. Go watch it and watch Brian make it up.
No nose tank, but rates are on average right now at 6.30. And just to give you a quick example, like on a $600,000 loan, the difference between a 6.75 to a 6.30 saves you around $180 to $200. So lowering borrowing costs are coming down, and we haven't seen, like I said, nose tanks, but costs are getting a little bit cheaper. Monthly payments might be a little bit cheaper as well, $180 to $200. So it's coming down slowly.
Well, and always, like always, is always indicative of whatever situation someone might be finding themselves in. Like for someone who maybe doesn't have another choice, well, maybe refinancing and getting off other debt off of you, regardless of what the rate is right now, might be the move to prevent foreclosures, which we're going to talk about in a minute. So if you're in a tight situation, you may not have another choice. If your back's against the wall, start making your questions, get your questions asked now. If you're not up against the wall, congratulations, you have some more time to wait. Yeah. And by waiting, it might be a little better here in maybe in November, by December, somewhere like that.
Another positive from rates slightly coming down is you have a little bit more buying power. So if you were at around 650 before, with that slight change of rates, maybe you're going to be around 675 to 700,000, depending on the type of property. But it gives you a little bit more purchase power, and it helps your DTIs come down.
Yeah. I mean, the other good thing that we saw based on the article that came out was we saw a 4% jump in August. Where people just feel a lot more comfortable and confident to make a decision of just hopping onto the housing ownership bandwagon. And so that actually shows a little good signs of what happens when interest rates start going down and it becomes a little more affordable.
You're talking about the pending home sales.
Yeah, pending home sales. I mean, it increased, and so 4%, that's not bad.
And I think that's great news for sellers, because the people that have been waiting to put their house up on the market, I think this is a good sign for them to say, hey, maybe I could put my house up. Market's still picking up, market's still moving, and even into the end of the year, into the later months, the market still looks like it might be a good time for me to list my house, because I don't think we're going to have that, we haven't been having that winter these past couple of years. It's kind of been like an inverse with the rates being all over the place. So that 4% is a little positive sign for, people that want to put their house on the market.
And again, it's 4%. It does sound kind of like a small little number, but compared to all like the sky is falling articles you read on the internet, it's like that's actually a good sign. So it's in positive territory, even if just by a little bit, but it's in stark comparison to everyone say, oh, pending home sales are in distress, they're in trouble, prepare for a 40% price dive, all this and that. And even last week we were talking about, well, pending sales compared to new build sales, well, there's even competition among them, but only in the parts of the country where there's new developments, and those developers are making some sort of like sales concessions that are very aggressive. So again, I'm saying all this because it's important that you understand what's happening relative to your local market, and that not everything we talk about and cover nationally is going to be the same in every single city.
No, absolutely. Absolutely. The other things that's actually starting to come back are those ARMs. And I'm not talking about my ARM or your ARM, the adjustable rate mortgage, and so they're coming back. Now it's making sense to even entertain that option where it's going to be a 5-year fix or a 7-year fix, and so obviously on a 5-year ARM, there's going to be a little more favorable than the 7. And what that actually means for a lot of our viewers don't understand the adjustable rate mortgage. I know if we go back to 2008, we hate those ARMs because they adjust, right? And at times they were just adjusting every month or adjusted every year. 6 months, a year, depending on what type of ARM you obtain at that time. These ARMs are adjusted after, if you do a 5-1 ARM, it'll adjust on the 5th year that you've owned the property, and then every year after, depending on what the market conditions are. And actually not a bad thing, because right now, before a few months back, it wouldn't make any sense, because an adjustable rate mortgage, you're like, well, I'm going to take the chance on that, but it's the same rate as a 30-year mortgage. Why don't I just go with the 30?
Yeah.
So for example, if someone is at home listening right now and they want to get in the market, you're saying that if they do an ARM on a 5-1 for 5 years, their rate is going to stay the same.
Correct.
And then after that, strategically, they could refinance into a regular type of 30-year fix.
Exactly.
Yeah.
That's a great tool.
And it's about usually anywhere from 0.5% to 1% lesser than a 30-year fix. Whereas before I mentioned, there was just no benefit. I might as well just go, if I'm getting, for instance, an ARM, just for example's sake, a 5.75 on an adjustable rate mortgage on a 5-year, or a 6% a 30. I think I'll go with the 30.
And it makes so much sense. I just I watched The Big Short a few weeks back, and I was listening to all the adjustable rate mortgage stuff, and I was like, that's so crazy. But what I think is even more crazy is that people didn't know how it worked.
Yeah.
So now looking at it, I always thought same thing when I got initially, stay away from the ARMs, stay away from the ARMs. And then as soon as I learned how they're working, if you're smart enough, like right now, we know rates are going down, maybe getting a 5-1 ARM or a 7-1 ARM locks your rate for those periods of time.
Yeah.
And then you could ride the wave down on the market and refinance within, the time that it makes sense for you to refinance, but it's a great hedging tool against a higher payment right now.
Yeah.
Well, the other time in 2008, we always have this misconception that it was an adjustable rate mortgage. Yes, it was, but you also it was 4 payment options. So you had a negative amortization, which means you paid less than what your monthly payment should be. And then the next choice was to pay an interest-only payment, which is a little higher than, not a little, it's going to be almost half the payment higher to go in an interest-only. Then you could select also a 30-year fixed payment mortgage, fully amortized, or you could do a 15. So you can 15-year fully amortized payment. So you can pick and choose
every month.
And guess what? Everybody chose
The lowest
payment.
Negative.
So we're all negative, and that's what got us into the situation. It wasn't the actual adjustable rate mortgage, and you're absolutely right. Some of us just didn't understand how to leverage the situation. If we only knew what we back then, it'd be crazy. I mean, it'd be a fun journey.
The other thing too, I think it's important to put into context is that, back then as well, the underwriting standards, I don't even know what I called them standards.
There was none.
Right. There you go.
I think you told me heart being a social security.
Yeah. If you could fog a mirror and sign a piece of paper, they're like, hey, here's a loan. That's just what made that also like dogpiled onto the ARMs are bad thing. Yeah. It's like, well, ARMs are bad. Well, look, there was catastrophe across the entire industry, despite what kind of ARM you had. Yeah. A 3-1 ARM, a 5-1 ARM, 7-1. Or the neg-am adjustable, like a pick-a-pay kind of stuff. But part of the qualifying standards being so terrible is really what ultimately was, I'd say, the biggest leg of the table to fall out from the whole thing. There were people that should not have been able to get these loans, because it was, you got good credit.
Yeah.
Well, credit doesn't dictate if you can make the payment every month. Income does. But it's right. We're gonna overlook income. We're gonna overlook assets. Oh, you got a good credit score, no problem. Like that was a massive contributing factor. So
no, totally.
Yeah, people making the smallest payment or thinking ARMs have a bad name to them. Like, look, there's a strategy. Just like a couple weeks ago, we talked about the mortgage accelerator calculator. Yeah. There are strategies to this whole thing. You don't have to just get stuck getting one loan or one type of loan or the fixed or the ARM, whatever. Like there's levels to this game, right?
Yeah.
And similarly, getting a 5-1 ARM now, there's a level to that. You can use this to your advantage to get into a home now. And then by the time 5 years rolls around, I'm hoping that you're in a better financial situation, less debt, more income. or maybe a second income if you're single now and you get married or whatever that situation might look like. Now, on the downside, could you lose your job between now and then? Yeah, that's true no matter what loan you have.
Yeah, no matter what.
Could you have to move out of the area and then sell your house? Yeah, of course you can. That's true no matter what kind of loan you have. So you really have to be honest and upfront about what is actually the potential casualties for you, and then what are the potential upsides, and then make your choice.
Yeah, 100%.
No, it's pretty crazy. You bring up a great point. But going back to the underwriter, what you had, I remember the acronym NINJA.
Mm-hmm, that's right.
Right? Do you remember what that stands for?
No income, no assets, no job.
Yeah, assets. Let's forget the A.
No income, no assets, and
no job, assets at the end.
Yeah.
Wait, but you got assets?
So there's none needed. So it's like, so what do you underwrite, right? It's just a credit score, and you put in employment and you just put right there. We wouldn't verify if you had a job for the last 2 years, 3. It just had to be 2 years consistently, but we wouldn't verify that. So that's crazy.
Hey, can we tell Brian about 2 old ways we used to do loans real quick? One, remember those TPS boxes? Remember we used to put them in the folders? We used to have these envelopes. You had to take your whole loan package and put it in the overnight, the courier service.
You had DocuSign?
Hold on. And then there's the other way we were able to do loans was fax. Fax a cover, like a fax loan submission with a doc list, and then every single document in order, bro.
And they were different colors.
So that was that was your Dropbox and your scanning,
dude. Exactly.
It was insane. Sometimes
you had
we
to
would
get
even
that
have
at certain times, and you had to know what areas collected their boxes, kind of like the postal service. You had to go at what times. Oh, can't do it there. We need to fund tomorrow. We can't put it in there because that won't be there on time.
That one picks up at 5. That one picks up at 7 p.m. And then remember this: some of the local banks here, the reps would actually come and pick up loan packages at the office and go and take them to their underwriter desk. It was a whole different world, dude.
It was different. It was different.
Oh my God, we're so old.
Yeah, in the comment section, put us if you guys ever obtained a Ninja loan.
God. Don't.
Nina loan. We'd love to know.
Nina and the Ninja.
Yeah.
So the moral of the story here, guys, is look at all your options, right? The market is getting better when it comes to things, and you looking at it going, oh, is it getting better? Is it getting worse? It's fine, and it's getting better. Yeah. And I think it's going to continue looking to get better as we make our course through the remainder of 2025. And then also look at our options. Look at the 30-year fix. Look at the 5-1 or 7-1 if you have to. And then if you're really just chomping at the bit to get into home ownership, make the moves. Go after it and go get it.
Yeah, there's options out there, definitely, for sure.
Yeah, definitely.
So let's pivot that, and then let's go talk about the other side of this kind of coin, which is the whole foreclosures, and that housing distress is kind of on the rise. I have a couple of things I'll chime in here just from my personal anecdotes, talking to some other friends of mine in and around this industry. But foreclosures jumping 17%. We have 101,000 foreclosure filings last quarter. That
crazy.
Seems like a lot to me, given the fact that we have more home equity than ever. So I'm honestly, candidly, I'm saying I'm a little bit surprised that we have this many, because there's probably a healthy percentage of these that could actually just be put on the market and sold rather than have to go through the foreclosure process.
But you know what? That's what you would assume, right? And we're always going to assume, but the situation in every state, and this is accounting not just for singling out a state, this is a nationwide thing. So in a lot of other states, the value is not even there. A lot of times you could have bought a home 8 years ago and the house is practically already after cost to hiring either a realtor and then paying your closing costs. You may not make anything. So you might as well just try to figure out, like, can I find a solution to stay in this home longer? And that's what most people do. And so therefore, whatever that payment is keeps accumulating to the existing balance. And so a lot of people, instead of going through, let me put on the market, let me just see how long I could ride this. In certain states like California, if you go through bankruptcy and that delays, a lot of times, I don't have time to go to court, so you delay and it can take time. So a lot of times that's how you're able to eat up a lot of that equity that you're in there. Or you have a home, which I just experienced this and closed that transaction 3 months ago. The house could be dilapidated. It could require a lot of work. And so the home being appraised as is, got it here in Chula Vista for $500,000. It's really worth more like $7, but because it's so dilapidated, it's going to require an investor to go in there and fix it up. In this case, it was habitable. It was dilapidated, but not enough where it wasn't habitable. So we're able to do a loan for the $500,000 with down payment assistance, and they're in. And so it works out certain ways. And that house was in the verge of going through actual foreclosure. But because we closed prior to, like 2 months prior to, we managed to save it that way.
So there's a couple things I wanted to ask because I jump right to the topic of foreclosures, but there's kind of some other things that might be possible here. So you make a great point about in lower cost areas, their appreciation has not been as rampant as other parts of the country, especially since COVID, where some places had 30 and 40% markups of increase of price. I get that. Even in some of those lower cost areas, though, why wouldn't we also potentially see some short sale numbers increase as well too? Because let's say someone is mortgaged to the hilt and they owe the same amount that's due, either because it's their first or a first plus a second that they have. I would think that we'd start seeing some more short sales as well, but that's not noted in the article at all. It's like, no, just foreclosures are up 17%, which means that so either the short sale isn't being, that option isn't being exercised by the homeowner and said bank, or it's that they are trying to and it's getting declined.
Yeah. Well, it may just be very well that banks don't want you to really know that information out here, that there's that other option, right? Because they don't want that option. They don't want to have to short sell and take a downfall on that. They'd rather just foreclose and let's be done with this.
Is there a difference on their books between them doing a short sale where they lose different than a foreclosure?
On the tax side, it's going to be a loss, right? So it's going to be they're going to take some sort of loss for it. But I'm saying it's still an asset in the end, whether it goes through foreclosure and they repossess it as an asset, or they go through a short sale and they just recuperate as much as they can, and then they're relieving the asset to whoever the buyer is, right? So if you went to go buy a house right now, it's in short sale, you're buying it from Bank of America, not from home seller.
Yeah.
But then Brian's a new buyer. The second you close escrow, well, they get whatever money they get, and now they're out. They don't have to go sell a property, which is why I'm saying it's interesting to me that there's going all the foreclosures, it's going all the way to foreclosure, because then they are taking back an asset,
have to go sell
and then they do have to get a BPO. And I was talking to Miguel about this the other day. He's like, I've got a lot more BPO requests this quarter than I have since like 2013, 14. And I'm all, really? So for some reason, people are bypassing their home sale and they're choosing the foreclosure route. The other person I mentioned, or I was going to mention to you guys just anecdotally, is our friend around the corner, Jason Turner, bankruptcy attorney. He goes, I'm fielding a lot of bankruptcy conversations with people right now. Now, in bankruptcy, you have the option of choosing your home, but if you have never heard this about bankruptcy, you still have to qualify. It's kind of a weird thing, right? You got to qualify for BK. But he said even then, some people, like the bank may work with them or not, depending on their income situation. And in the cases where they have equity, then they can sometimes be able to do some debt negotiation because there's enough, let's say, in the totality of the deal for it to make sense that the lender will negotiate.
Yeah. I mean, we're seeing this all the way around. What's our consumer right now debt? It's like 1.2
in the T.
Our credit card balances, like almost 1.3 trillion.
It keeps growing. You know what I mean? And so these are things that are going to lead up to other things. And so now we have a government shutdown. These things will affect the consumer. It does have it, and it will affect it.
It's like a water pipe. It needs to burst.
Absolutely.
Somewhere.
Now, why is there more foreclosures and we're not hearing the short sales? I mean, I just also think the article is really just focusing on the foreclosure side, and people, a lot of times, they don't understand there's other options. There's other ways out. You know, there is forbearance out there too. It's like you can go and try to negotiate that. So there's a lot of that, you know. And so
I'm glad you brought that up. I didn't even think of bringing up forbearance, but can I talk about that for a second?
Yeah, please.
Like, please understand that if you're in a situation where maybe you have become medically disabled or you got injured at work, you can actually apply for certain forbearances with your lender. Now they'll decide what they can and cannot accept as far as terms of repayment or recasting your loan or things like that. But if you find yourself in a situation where your earning that had qualified you to make your payment is no longer there or has subsequently diminished because of something that's happened, such as a medical emergency or the ability to work or disability or something like that, absolutely please call and find out a solution for that. In some cases, they can actually work with you and work something out.
Yeah, no, I have a client that he bought a home a little over a year and a half ago. He's a veteran, and we provided a VA financing, and he's like, what can I do? Like, I contact the bank. Let's see what options they offer you. And sure enough, they're offering a forbearance. So that's one thing that we have found out since the pandemic is banks are willing to work with you. Banks don't want foreclosures in their books. Remember, they're not realtors. They're bankers. They know how to, manage their books by collecting payments, etc. So they're not in the business of foreclosing. They're in the business of taking payments. And so therefore they're going to try to figure out a solution to how they're going to continue to take payments. In this case, and one thing that we found out in 2020 was, that banks, because of the moratorium that was in place, banks learned like, hey, let me just do a forbearance. I can do 3 months. I can do 6 months. And sometimes they did over a year, even 2 years. Yeah. And so whatever they weren't able to pay, they just put it back in the balance.
Mm-hmm. Yeah, tacked it on.
Yeah, tacked it on. I did it for 2 of my investment properties. I didn't know what was going to happen, so I took it, and they offered it to us. So I'm like, well, wait a minute. I'm going to take out a loan. Hopefully, I don't need it. Knock on wood. But if my payment's $3,000, I'm essentially, and I go 6 months, I'm essentially borrowing at 0% interest on that. Mm-hmm. Yes, I'm going to owe later, but at least I can use that money as a cushion for something else.
And in the case you're talking about, you're receiving income on the front side of that because it's rental. And so it's really offsetting basically future income of gross income against what the payment's going to be.
Correct. And I didn't know. Luckily, I didn't need it like that. So I forfeited right away. Like it sounded good, but it's like, just people that really need this, there's other options.
So there's an important lesson in that, though. Is like sometimes when there's an opportunity there in front of you that will help create a better situation for yourself, you got to take a look at it. And especially if you are in like a more detrimental situation, like I was explaining earlier, then you absolutely should be raising your hand and saying, I need help.
Yes.
I need to figure this out. Please, can you work on listening to what's going on? And sometimes they'll ask you to submit some paperwork. Well, evidence your hardship. Show me what this is. And I've seen that happen where you have to submit some, maybe it's medical paperwork or you're released from work because of disability, or especially if you got injured on the job, that makes a big difference. Yeah. So just remember, like, please don't shy away from your situation being what it is, and don't let embarrassment run a priority of whether or not you fight to keep your house.
Exactly.
Okay?
Exactly. Especially with all the options that are out there for people now.
Yeah.
They're so protected. Everybody's getting so protected. It's crazy.
Yeah. And I know also, no, I shouldn't say I know. I suspect that there's a larger than normal amount of these foreclosures that are probably from within the last 3 to 5 years, when prices have been high, rates have been high, payments are high. You see property tax is a really big conversation right now, just on the political spectrum of like, whether should we even have property tax after you pay off your house, or should we even have it at all if you have local tax? Like, there's all these kind of tax conversations. So I know cumulatively people's out-of-pocket expenses every month are very high. And when you got a $5,000, $6,000, $7,000, $8,000 a month total payment, that's a lot of money to sustain ongoing long term if your job has ebbs and flows and your income goes up and down, or you're in a state where the property taxes change year over year. Unlike some of the other places like California, where it's going to be 1% in the county plus your bond measures and things like that.
Yeah, exactly. Usually about 1.25%, but still, we have a client right now purchasing at $890,000. It does have a Melrose, which is an additional property tax because of the schools and everything that was built around it. Since it's a new community, the property tax alone was $1,250
a month.
Yeah.
Correct.
Oh, dude.
It's like $1,250 a month. It was like $894 just for the property tax. And then you have this Melrose, like $300 and some dollars. So it ended up being about $1,250.
Is there HOA on top of that too?
The HOA was like $63. Not that bad. But
well,
still.
It's just my mind.
Believe me, hey, I like HOAs on single family residents, not on condos. Single family
my mind starts thinking all these. Oh my god, and this and that and.
No, I mean,
and then insurance for a new build.
Yeah.
Sometimes. On top of that, you have inflation. You're here in California. You have a tax on the gas. It just doesn't end. It can get pretty crazy.
So, go ahead. We can make another point about foreclosures.
One of the things that I did like is what from Autumn, the CEO Rob Barber notes that while foreclosure levels are still within historically reasonable ranges, the consistently quarterly increase could signal emerging borrowing strain in certain regions. I like the way he says historically reasonable. It's like, just put it out there, dude. Just put it out there.
Don't sugarcoat it. Just say it straight up.
Just come on. They find these clever ways of making it sound like good, but it's still kind of bad. I mean, this is...
Read between the lines.
There you go.
Well, leading up to the 2008 and 2009 collapse, his foreclosures were like at all-time lows. Because like everyone's making payments, everyone's on time, everything's looking good until it's not. And so I do see why the historical is important to reference. But I'm glad you said that. That was a good setup. You don't know what the setup was. The great setup. Here's why. If you are an investor and you're looking at, I'm looking to buy a foreclosure in the next 12, 24, 36 months, guess what? There's more foreclosures coming. You're going to have plenty to pick from. So I don't celebrate the fact that people are losing their homes and they're going to have to find a place to live, whatever. That's not it at all. There's no celebration and lap in that.
Never.
But for those of you who are acquiring real estate for the sake of portfolioing them and holding on to them long term, it's likely, because we're at historical average, if it does continue to increase, there's going to be more selection on the market. Like we covered last week, in case you missed that show, we talked about how investors are making another resurgence again in home buying, and 25% of the homes last quarter were bought by investors. So again, they're in the mix with everyone else trying to buy, everyone else trying to sell, whether it's foreclosure, if it's already fully owned, paid in full, whatever the situation is. But I think on the heels of foreclosures is going to be more buying. I think this is going to create new inventory.
Yeah.
And it's going to be pre-existing inventory, which we already have a little bit of an uptick. So I think pre-existing inventory is going to making a comeback in quarter 4.
Absolutely. We already saw in the previous article, it talked about 4% pending sales going up in August. That already tells you if we see a little downtick on the rate, it just brings a lot, the pool of buyers will just increase little by little.
Yeah.
Right. And then if we start really hitting those, mid 5s, low 5s, it's going to get crazy.
Yeah. Oh, yeah, absolutely.
It's going to get crazy.
We had someone comment last week on last week's video, like, hey, someone call me if rates hit 4.
Yeah. Same. That's what they told me.
I was like, yeah.
And they can. And
you got it.
Eventually.
And they will. On government, you can get in the 4s, but it's going to cost you, right?
Yeah.
If you don't want it to cost you that much, you're still in the low 5, mid 5s. As a matter of fact, today it's going to be a little higher just because of the market conditions. But other than that, it's like we already saw that if we're even hitting the low 5s, it already creates a buzz.
The momentum is crazy.
And, so we got so busy, in the beginning of September. And then as soon as Uncle Powell talked, it's like the brakes just pumped.
Yeah.
The brakes pump. That's how much influence he has on the market. So when they're talking about Donald Trump, all this, it's him. He's got it. He's the most influential man there is in the world.
And that's why I believe that it's so important to just get pre-approved if you're going to buy within like 6 months. The sooner the better, because of those exact days that you have good pricing. The following day you can have horrible pricing, but the longer that you're in the market, you're going to be able to see, okay, on a good day I could lock. I have to wait maybe a little bit more for I could lock again, but you'll start to understand how things move, and you can snag good deals if you're constantly on the prowl.
Yeah.
No,
and there's a big buzz too right now with lines of credit as well, guys. Huge buzz with all that, and I think a lot of people are trying to avoid this whole foreclosure situation. So, like, let me get a line of credit on my property, or let me get a line of credit on an investment property. A lot of people are getting, they're just getting strapped. I get a client, they call me. He lives in Texas. He makes a great living, did 34 plus years in the military, has a good retiree pay, 100% disabled, using his GI Bill. That's quite a bit of money, and when they're saying, I want to take out at least $80,000 to $100,000 out of my investment property to pay off on my debt because I recently lost my job, and I do have another job coming up, but I need to pay this. And I'm like, okay, so tell me a little bit of the situation. Well, I'm looking to pay off a truck that, I owe $40,000, but my payment's $1,000. I have this, that. So I'm already thinking $100,000 line of credit is going to be roughly about $1,000 to $1,200 payment. So I go, are you going to pay all these student loans and all these? I go, those have little debt and it's a line of credit. So you got to actually have a tactic of how to pay this off. Maybe you do pay off the truck $40,000, it's $1,000, and not pay everything else off that has a lower interest rate. Like for instance, a student loan that he owes like $20,000, the rate's going to be like 2-3%. Why do I want to pay that if my rate's going to be 7-8%? I don't need to pay that and have an additional payment for that. I'm paying more for that student loan. If that makes sense.
Yeah,
Really
yeah.
sense.
So like those conversations need to be had, and you have to be out there vocal. You have to raise your hand and ask the tough questions.
Yeah.
It may be tough for you because you don't want to put your vulnerability out there. You don't want to share your private information. But listen, if you share the private information, that's how you're really going to get the help, proper help.
And hesitation can actually hurt you, because the more that you start racking up debt, and if you start paying more things, your debt to income ratio comes into a big factor when you're getting a HELOC or any type of line of credit, because they go based off your credit if you're doing it for, your income if you're doing it for a primary residence. So if you already start feeling those pinches, ask now, start getting inquired, start getting informed, because you don't want to wait till the end and you have the debt, you have the out, but you can't get it because you can't approve.
Exactly.
Like that, and it sucks. And it's happened before where they have the equity, their income just doesn't allow, their debts don't allow for them to be able to tap into that money.
Yeah. So don't get into the situation, essentially, is what we're saying.
Yeah.
You know, if there's room for improvement right there, just
take it.
Get it done. You know, raise your hand out there. You have a bunch of resources out there that you can connect with, and talk to your local lender in your area and just figure out what's the best solution for my situation.
Yeah, definitely lean on us if you're in a situation where it's you're a couple steps before you end up having to have the foreclosure conversation. Like do that. And you know, this isn't, it's kind of a segue, not really a segue, but in case y'all missed it, last week we had a guest on the show for Friends of Mortgage Heroes, Sarah Khashrabadi, and she's a consumer protection attorney. And one of the things she was telling me is that ever since the COVID mandates lifted for collection activity has been aggressive and constant on people. So if you find yourself in a situation where it's beyond what we might even be able to do to help you financially with your mortgage, your line of credit, we have someone in our corner who can help at least listen to your situation and maybe help give you some guidance and advice. So yeah. And
every time anybody calls, this call is recorded for is everything to collect the debt? I'm like, what the hell do I owe now?
Oh gosh,
it's funny.
So thank you guys. I mean, I know foreclosure is not the funnest thing to talk about, but look, it's happening. I'm sure that we'll probably have to cover this topic again in Q4 at some point. It'd be nice if we could see this kind of like taper off a little bit. I really still believe in my heart of hearts that if you can sell your house and prevent foreclosure, that's the thing you need to do.
Exactly.
If there's even $1,000 at the end, that's better than you losing your house and not making anything and still having any debts and all that kind of stuff connected to you that you have to pay off.
Absolutely.
So.
Credit is so important when you have foreclosure, and you have to put that. That's one of the declaration questions that's always asked. Have you had a foreclosure in the last 7 years? Conventional, you can't have one.
Right.
You know, FHA, it's 3 years. VA, it's 2 years.
Even if you're in duress right now, please try to think about the future decisions you have to make and what the impact of the choices today are going to be on those as well.
Yeah, exactly. Exactly.
Well, thank you guys for another great show. Thank you all for watching. As always, remember to like the channel if you haven't already. Hit that notification bell so every time we drop a new video, you hear about it first. And then check out our playlist, Friends of Mortgage Heroes, where we interview our friends in and around real estate and all the things they do to help you and us win in mortgage and real estate. Thank you guys for an awesome show this week, and we'll see y'all again next week. Later.
See ya.
If you enjoyed this video and you want more of our content, subscribe here. And if you'd like to watch another video right now, click here.